Sunday night, 6 p.m. Eastern. The futures markets light up in Asia, and the next chapter starts writing itself. $688 billion is gone. The liquidity that propped up U.S. markets for 2 decades has thinned out, and what's left can vanish in minutes. Your retirement account is sitting there right now, fully exposed to a system that doesn't wait for your permission. The algorithms are already armed. The sell programs are already queued. And if this move breaks the wrong levels, Monday morning won't feel like a down day. It will feel like a different world. This isn't guesswork. It's mechanics. It's how thin liquidity behaves when it meets automated selling. The leaders of the bull run, the stocks everyone treated like generals, are standing in the crosshairs. The so-called safety nets are full of gaps, and the people who understand that aren't shouting it from rooftops. The countdown is already running, and most investors don't even know they're on the clock. Because while ordinary people enjoy their weekend, families sitting down for Sunday dinner, the country exhaling, the news cycle calming down, the most dangerous phase of modern finance is quietly lining up. Sunday night, 6 p.m. Eastern Standard Time, Asian futures reopen and the calm breaks. People are already calling it Black Sunday, and the name fits, because what happens in the first minutes of that open can set the tone for trillions of dollars in global wealth. The trigger is brutally simple. China has liquidated $688 billion in U.S. Treasury bonds. To anyone who doesn't track markets, that number sounds like an abstract headline. But the reality underneath it is violent. For years, Chinese capital functioned like an invisible stabilizer. Consistent demand, dependable bids, steady participation that helped keep U.S. asset prices elevated. Whether you call it support, ballast, or pillar, it played the same role. It reduced the odds of disorder. And now that pillar is being pulled out. And when a foundation disappears, you don't adjust, you drop. Here's the mistake most retail investors make. They think weekends are safe. They assume the market is closed, as if price discovery politely pauses until Monday's opening bell. That belief is comforting and dangerously wrong. The global market doesn't sleep. It just changes rooms. The real flows move through Tokyo, through London, through algorithms that don't need daylight, don't need headlines, don't need human emotion. The system is alive, scanning, pricing, recalculating, and it's built to move fastest when you're paying least attention. Sunday night carries a specific risk that most people only learn about after it happens: the gap down. A gap down isn't a gentle decline or a slow bleed. It's a discontinuity, an opening print far below Friday's close. Instant, unforgiving. 10% evaporated before you can place a trade. And the terrifying part is not the number. It's the timing. There's no time to react, no time to sell, no time to hedge, no time to protect the wealth you built over years. You just wake up, open your account, and realize the move happened without you. That's the modern market. It's not a debate, it's execution. Because the dominant force today isn't human judgment, it's automated logic. And that logic is simple. Sell first, analyze later. When volatility jumps, when liquidity thins, when fear spreads across correlated assets, machines don't hesitate. They don't weigh narratives. They don't feel doubt. They obey their rules. They hit bids. They pull orders. They amplify the move. And when the Asian bell rings Sunday night, if the first wave is ugly, the execution won't be selective. It will be broad, mechanical, and ruthless. China stepping back from the dollar-heavy system creates what professionals call a liquidity vacuum. And liquidity is oxygen. It's the thing that lets markets breathe. Without it, prices don't slide, they suffocate. This is what most people misunderstand about crashes. They think crashes happen because everyone sells at once. A stampede, a frenzy, a wall of panic. That image is emotionally satisfying, but it's incomplete. Crashes don't happen only because sellers show up. Crashes happen because buyers don't. The bid disappears. The market looks around and finds an empty room. And when there's no one willing to buy at the prior price, the system does the only thing it can do. It drops the price until it finds a buyer. Any buyer, somewhere lower, sometimes much lower. In a vacuum, that somewhere isn't 5% down. It can be 20, it can be 30, it can be the kind of repricing that erases half a decade of careful gains in a handful of minutes. That's why the risk is existential, not emotional. 5 years of progress gone in 5 minutes. Now extend that from individual portfolios to institutions. Pension funds across the country are already on thin ice, barely solvent, highly sensitive to drawdowns, heavily dependent on market stability to meet obligations. A sharp drop doesn't just hurt performance, it triggers forced decisions. Liquidations, rebalancing, fire sale selling into weakness. That creates feedback loops. Selling drives, prices lower, lower prices, force more selling, and suddenly you're not in a bad market. You're in a spiral. Millions of retirees are sitting on that fault line, and the market doesn't care how long they work to earn those benefits. If the structure breaks, it breaks. And that's why this moment matters, because the earthquake doesn't schedule itself for a convenient hour. It hits when liquidity is thinnest, and Sunday night is exactly the kind of window where thin liquidity meets global shock. Normally, when markets start to fall too fast, people assume there's a backstop. The unofficial stabilizers, the institutions that step in, provide bids, inject liquidity, stop the bleeding, call it what you want. The rescue function, the emergency buyer, the team behind the curtain. But the argument here is that this time is different, not because the desire to stabilize disappears, but because the room to do it shrinks. If inflation is still sticky, if currency credibility is sensitive, if global demand for dollar assets is wobbling, then the old playbook becomes harder to execute without collateral damage. You can't flood a system with new money forever without eventually threatening the money itself. That's the constraint. And when the stabilizers are constrained, the market starts to behave like it has no adult supervision. So yes, if the drop begins, they may try to catch it. They may throw bids at it. They may attempt to calm it. But if the flow coming from the other side is large enough, if the selling pressure is relentless enough, then the net tears. And when the net fails, the fall continues. And in the middle of that chaos, something else happens that always happens in true repricings. Capital looks for a place to run. Money doesn't vanish, it moves. It escapes the assets that feel fragile and searches for the thing that feels like an exit. In this narrative, that exit is framed as silver, the place capital runs when paper feels like a trap. Stocks are crashing, portfolios are bleeding, fear is spreading, and one asset is positioned to surge as money rotates out of risk and into what it believes can't be printed. The point isn't the ticker symbol, the point is the flow, paper to metal, risk to refuge, comfort to survival positioning. In violent markets, that rotation can happen fast. But the stock market shock is only the first domino, because modern finance is interconnected like a brittle structure. Tap the wrong piece, and the vibration spreads. Pull out one support, and the entire framework starts to sway. And then it moves from Wall Street to Main Street. Because once people see their retirement accounts get cut, once they feel that decades of savings can be erased in minutes, logic takes a back seat. Psychology takes over. And psychology is the strongest force in finance. Not because it's irrational, but because it's contagious. Monday morning, before the sun is fully up, before the first coffee is poured, before the workday begins, people don't rush to banks to deposit money. They rush to withdraw it. They try to grab whatever they can, while they can. That's how bank runs begin, not with careful planning, not with spreadsheets, not with calm debate, but with raw, primal fear. And here's the brutal reality. The banks can't meet that demand. They never could. The system is built on fractional reserve banking, the polite term for a simple truth. Most deposits are not sitting in cash, waiting. They're loaned out, invested, leveraged, turned into long-duration assets that cannot be liquidated overnight without losses. So when thousands of people show up at once, the machines run dry, the limits appear, and the temporary measures start getting discussed. Not because the money is gone on paper, but because access to it becomes constrained in practice. And that's the setup. Sunday night opens. Liquidity thins, algorithms execute, prices gap, psychology spreads, and the system is forced to reveal what it really is, stable only as long as confidence holds. So when thousands of people hit ATMs on Monday morning demanding their cash, the machines run dry, the new withdrawal limits kick in, and bank holidays suddenly become part of the conversation. And here's the point most people miss. A market crisis and a banking crisis aren't two separate storms. They're the same collapse, seen from two angles. When one side breaks, the other follows, by pure mechanics. History keeps repeating the same rhythm. 1929 began on a Monday. 1987 began on a Monday. Why Monday? Because fear compounds over the weekend. Bad news piles up, spreads, and grows in the dark. By Sunday night, anxiety hits critical mass. By Monday morning, panic is already in motion. But one market doesn't wait for Monday, because it never closes. Crypto trades 24/7, and that makes it the first domino. Sunday afternoon, before stock futures even open, crypto can get hit with what traders call a liquidity flush, a fast, violent, stomach-turning drop. Not because crypto goes to zero, but because traders need cash immediately. Here's the chain reaction. Big money, funds, institutions, leveraged players, holds positions across everything, stocks, bonds, crypto, commodities. It's all connected. When equities crack on Sunday night, brokers fire off margin calls that demand instant cash to cover losses. And the only liquid assets you can dump at any hour, any day, are cryptocurrencies. So they sell Bitcoin, they sell altcoins, they sell anything digital, fast, just to raise cash and survive the margin call. The selling is ruthless, indiscriminate, and driven by pure survival. In a cascade like that, Bitcoin can drop 30%, 40%, even 50% in hours. But that's where the difference shows up. Unlike stocks, crypto may bounce back, because it isn't directly anchored to a single government, a central bank, or a failing institutional backstop. After the forced selling burns out, the narrative shifts. Digital assets start looking like an exit ramp from a stressed dollar system. But that realization comes later. First comes the shock, and it will be extreme. Now zoom out to the real epicenter, the bond market. Most people ignore bonds because they're boring, but bonds run the entire machine. When China unloads $688 billion in U.S. Treasuries, supply floods the market. If demand doesn't rise with it, prices fall. And when bond prices fall, yields rise. That isn't a theory, it's the wiring. That's why the 10-year Treasury yield pushing toward 5% matters so much. Stock valuations are built on models that compare earnings to risk-free yields. When yields rise, the math that supports stock prices breaks. It's automatic, it's systematic. If the 10-year yield cleanly breaks above 5%, the model-based fair value for the S&P 500 can reprice lower by roughly 30%, not slowly, but in a snap. This is the bond market squeezing the stock market in real time, and yet you don't hear it clearly on television. You don't see mainstream finance media screaming about Sunday night. Why? Because the system depends on retail staying put, holding the bag, being the last buyer. If everyone was warned, the selling would start immediately and the break would happen before the weekend even arrives. So the messaging stays calm. The exits stay open for the people who already moved, while the crowd remains inside. That imbalance, who knows who acts, who can hedge, isn't accidental, it's strategic. The well-positioned are already set. Short exposure built, put options in place, capital rotated to safety. And they're not just defending, they're positioned to profit. That's not a conspiracy. That's how wealth shifts in every major crisis. The informed take from the uninformed, the prepared benefit from the unprepared. And on Black Sunday, the next major transfer begins. Even the safety systems aren't comforting. Circuit breakers are designed to halt trading at 5%, 7%, 10% drops. But circuit breakers don't stop a crash, they pause it. And sometimes the pause makes it worse because fear builds while everyone watches, frozen, waiting for the reopen, when the selling often resumes harder. A halt on Sunday night isn't safety. It's a signal that the machine is failing. And when the machine fails, the rules change. Here's another uncomfortable truth. The appearance of a broad, healthy stock market is built on just 7 names: Nvidia, Apple, Microsoft, Amazon, Google, Meta, Tesla. For years, these giants carried the indexes and created the illusion of stability. But on Black Sunday, the leaders get hit first. And when leaders fall, everything underneath them buckles. The math is simple. Those 7 stocks are close to 30% of the S&P 500's total value, 30% in 7 companies. When liquidity disappears and selling starts, the most crowded, most expensive, most stretched names become the primary targets, not because they're bad, but because they're the easiest to reprice. A 20% overnight hit to big tech isn't just possible, it's plausible. And when those names crack, the market loses its anchors. The index becomes a trap. And that's before you reach the real accelerant: leverage, hidden leverage, everywhere. Record levels of margin debt, echoes of the dot-com era, investors borrowing to buy more, convinced the market only goes up, convinced leverage is free money. That belief shatters the moment prices slip, because even a small drop triggers margin calls. Brokers demand cash immediately, and if you can't pay, they liquidate you automatically at whatever price the market offers. Forced selling creates lower prices, which triggers more margin calls, which creates more forced selling, a self-feeding spiral. And once it starts, it doesn't ask permission. It just runs. A margin call is straightforward and vicious. Your broker demands immediate cash to cover losses on borrowed positions. If you can't deliver within hours, the broker liquidates your holdings automatically at whatever price the market is offering. That's forced selling. Liquidation driven by rules, not judgment. And once it starts, it feeds on itself. Prices fall, margin calls multiply, more accounts get dumped, prices fall again. A self-reinforcing spiral. On Sunday night, the leverage that inflated the bubble becomes the mechanism that detonates it, wiping out traders who never believed they'd get the call until it's already too late. And the shock doesn't stay inside equities. It spreads into everything, starting with real estate. When portfolios implode, people don't feel wealthy anymore. And when people don't feel wealthy, they stop buying. That's the wealth effect in reverse. Deals that looked fine on Friday suddenly get canceled on Monday. Pending home sales stall, luxury markets freeze, open houses go quiet. A housing market that's already stretched and fragile takes the final shove, and the stock crash becomes the catalyst for a synchronized real estate downturn. Then comes a support pillar most investors barely notice: corporate buybacks. Over the last decade, companies themselves have often been the largest buyers of their own shares, borrowing at low rates to repurchase stock, boosting prices, and lifting executive compensation and earnings per share optics. But rates aren't near zero anymore. Growth is weaker, and easy financing is disappearing. If buybacks slow or stop, the market loses a major source of steady demand, an artificial floor that masked underlying weakness. Without that support, prices must reprice to what the market will pay without financial engineering, and that price can be far lower than where many stocks trade today. Now add volatility, the VIX, the so-called fear gauge. In calm periods, volatility can be dampened by positioning and derivatives flows. But in a true shock, volatility doesn't rise so much as it erupts. And when volatility spikes, it triggers automatic selling in huge systematic strategies. Risk parity funds and volatility targeting portfolios managing vast sums. Their mandate is simple. When volatility goes up, reduce risk. That means sell stocks, sell risk assets, mechanically, regardless of valuation or fundamentals. This is how a sell-off turns into a cascade. A market already choking on panic gets hit by additional rule-based liquidation from machines that don't pause, don't negotiate, and don't feel. And there's a wild card that can pour fuel on the fire: geopolitics. Markets that are already fragile don't need a new problem, they only need a spark. Escalation in key choke points, disruption fears around energy, rising tension between major powers. Any headline over a weekend can amplify an existing breakdown. In that environment, even the threat of conflict can be enough to accelerate de-risking across global portfolios. What makes this especially dangerous is the psychology of the last decade. A whole generation of investors has grown up in a world where the default playbook is buy the dip, hold forever. The system always backstops markets. Many have never lived through a true prolonged drawdown. A crash of this magnitude doesn't just damage portfolios, it damages belief. And once belief breaks, the behavior changes. People withdraw, move to cash, swear off equities, and stay away for years. That's how you get a long bear market, not only from fundamentals, but from trauma. All the amplifiers line up at once. Concentration at the top, leverage underneath, forced selling, weaker buyback support, volatility-triggered liquidation, geopolitical risk, and a shock to investor psychology. Each one feeds the next. This isn't framed as a normal correction. It's a systemic unwind of what was built over the past 15 years, and it begins when the Sunday night futures session opens. And Black Sunday wouldn't just be one night. It would mark a before and after. The world that opens on Monday morning would feel different from Friday afternoon, not only because of the numbers on a screen, but because confidence would be wounded. The damage would be measured in years of behavior. Fewer risk takers, fewer long-term investors, and a generation that learns fast that markets can fall hard and stay down long enough to change how people think about money for the rest of their lives. These investors won't just take a loss. They'll take the lesson and leave. They'll move to whatever feels safe: cash, short-term bonds, anything with the illusion of stability, and many won't return to equities for years, if ever. But markets don't run on memories. They run on flow. They need new buyers, fresh capital, and constant participation. When an entire generation stops showing up, the market doesn't bounce back. It starves. Prices stagnate, growth slows, and the story that stocks always recover starts to die in public consciousness. That's the long tail most people ignore. Now bring pensions into the picture. This is where the arithmetic turns brutal. Many pension funds are already stretched, relying on roughly 7% annual returns just to keep their promises. A sudden 20% drop doesn't set them back a month. It sets them back years. And the recovery math is cruel. A 20% loss requires a 25% gain just to get back to even. Doing that in a broken market, with capital fleeing and volatility exploding, becomes a near impossible task. So the pressure shifts from spreadsheets to people. Benefits get trimmed. Retirement ages rise. Cost of living adjustments vanish. The commitments made to teachers, firefighters, police, and municipal workers get rewritten after the fact. This isn't just a market event. It becomes a social shock that lands directly on households that did everything right and still get told the money isn't there. But while institutions strain and confidence fractures, a familiar pattern shows up. Panic forces a migration into hard assets. In every major crisis, one corner of the market doesn't just survive, it becomes the destination for frightened capital. The claim here is that this cycle's standout wouldn't be stocks, and it wouldn't be paper promises. It would be precious metals, especially silver. Silver is still small compared to the oceans of money and equities and bonds, and that's exactly why it can move violently. When even a sliver of trillions looks for a new home, the pressure on a tight market can become extreme. Sharp spikes, fast repricing, and a rush driven by fear rather than valuation models. Silver also has a dual identity that changes the narrative. It's treated as a monetary metal in stress, and an industrial input when rebuilding begins. It's embedded in electronics, energy tech, vehicles, medical equipment. That combination can amplify demand at the worst possible time for supply, creating the kind of squeeze that moves faster than most people can process. Gold rises in fear. Silver, in this framing, can overshoot because it gets pulled by both fear and function. Then comes the twist. Normally, a crash sends capital into the dollar, but in this story, the crash is linked to stress in the dollar system itself. Reserve confidence weakening, large holders rotating away, alternative trade channels expanding. If investors start treating the dollar as part of the problem instead of the universal shelter, you get the nightmare configuration. Risk assets falling while the currency weakens too. The result looks like stagflationary stress, prices rising as asset values drop, where safety becomes harder to define, and capital hunts for anything tangible or structurally outside the blast radius. That's why the urgency is framed as immediate, not after things settle, but before the opening shock. If you're exposed, the message is to reduce that exposure ahead of the weekend, through hedges, downside protection, or raising cash, because once the gap happens, you don't get a clean exit. And if you're seeking safety, the emphasis is on assets that don't depend on market hours or financial plumbing, things you can hold directly, not just claims on a screen. The priority isn't scoring a win. It's not getting trapped when liquidity vanishes and the system starts changing rules mid-game. By Monday morning, the environment could feel unrecognizable. Headlines screaming, confidence cracked, institutions scrambling, and ordinary people realizing they were positioned for a world that no longer exists. In that scenario, the goal isn't celebration, it's relief that you acted early. The core message is simple. Liquidity is what makes prices possible, and if a major source of liquidity turns off, markets don't negotiate, they reprice. The countdown in this script ends where it began, Sunday night at 6 p.m. Eastern, when the futures session opens and the question stops being, "What do you think?" and becomes, "What did you do before the gap?" Thanks for watching. We appreciate you being here. If you liked the video, please subscribe for more. Feel free to leave a comment with your questions or ideas.